Let's bring in Damp Spring Advisors CEO Andy Constan. Andy, great to see you again. Thanks for joining us.
Hey, Melissa. Thanks for having me.
First, I want to ask just what your take is on the Fitch downgrade of the U.S. credit rating to a AA+ from a AAA. I mean, I understand that this is not the first downgrade that the U.S. has had, and it gave up its AAA rating at the other ratings agencies. But will this have any impact?
Yeah, practically not really. No one's going to stop buying the U.S. debt. The U.S. will be able to honor its payments because it has no foreign currency debt, so it prints the money it needs. So it shouldn't have any practical issues. But of course, it's not something you want to hear. And it also talks about the longer term issues about what the buying power of the dollars you receive in the future when you buy bonds is going to look like.
All right, let's get to the Treasury issuance. We got the amount, which was greater than expected. And I guess the devil's in the details, Andy, because that's what we're going to get tomorrow. What are you expecting here?
Yeah, so tomorrow, the very large issuance that was announced yesterday is going to be, the composition of that issuance is going to be described. And for the last 9 months, the Treasury has been undersupplying the market with there's been a declining amount and small amount of Treasury bonds, and in this quarter, most recent quarter, there's been a huge issuance of Treasury bills to fund the government. And so that composition matters for long-term interest rates. When the market's undersupplied, you can have what you've been having, which is a suppressed long-term interest rate. And when it's oversupplied, longer-term interest rates can begin to rise again. And so tomorrow we'll see, and the street's around $250 billion for Q4 of the $852 billion that is scheduled to be issued.
You were just saying what Wall Street had been pricing in terms of what we're expecting tomorrow.
Yeah, sure. So again, around $250 billion out of the $852 billion is about what's expected. It could be lower depending on what the Treasury decides. They could continue to issue a ton of bills, or they could start returning to more normal issuance, where about 80% of the issuance is in coupon bonds. And that'll have a major impact. If they shift to the high amount of bonds, that'll have a major impact on financial assets. It'll cause the curve to bear steepen, meaning the long-term interest rates will go up, and that'll hurt multiples on equities. So it's a very important number to watch tomorrow. And if we're above 300 billion, I think the market is going to really struggle, both the long-term bond market and the equity market, to absorb that supply over the next 4 months.
So, Andy, it's Karen. Let me ask you about how they decide the sort of cadence of what they want to issue. I sort of don't get it with bills being so much more expensive than bonds. That would make me think, well, why don't they do all bonds? Do they have any guidelines that they have to meet? And could the market absorb all bonds?
Yeah, so they definitely have guidelines. They have, for the long term, have had a historical range of total amount of bills outstanding relative to total federal debt of between 15 and 20%. And if they were to issue all bills in the coming quarters, they would be well into the mid-20s, like 22, 23%. So there's nothing preventing them from doing that. As you rightly said, the cost is prohibitive because it's higher than the long-term bond cost is right now. But nothing preventing them by rule. It's just by habit and sort of their mission. And at the same time, absorbing $1 trillion of 10-year notes or 30-year notes or a spread across the whole yield curve would have a much, much bigger impact than $1 trillion of bills, which we've basically seen over the last four months. Tremendous bills issues, and asset prices, stocks in particular, are up during that time. So the market can absorb bills very, very easily. It's bonds it struggles with. And so the objective for the Treasury is to try to, thread that needle to not massively impacting the long-term interest rates, not flooding the market, but, taking advantage of better financing options right now and moving toward bonds.